Hello and welcome to Options in Plain English. Today we're going to continue analyzing option Greeks, and having already discussed delta in a previous lesson, we'll move on to perhaps the second most important one, theta. Theta measures time decay and is the theoretical amount that an option would lose after 1 day, assuming everything else stays the same. Options are expiring assets, and at expiration, their extrinsic value will go to zero. Theta measures this gradual loss of value as time passes. Traders are sometimes surprised by how their options are negatively affected with the passage of time, and this is one of the main reasons we'll dive into the ins and outs of time decay. A deeper understanding of theta will allow you to incorporate it into your trading plan and will also allow you to more accurately predict profits and losses as certain conditions materialize. If you decide to pursue premium selling strategies, such as selling naked or cover options, or any option strategy where you are net short options, you will also understand how theta works in your favor and how you are rewarded for the risk you take as certain events happen or don't happen. By the end of this lesson, you will understand how theta affects your options positions and also how to take advantage of it, or at least minimize its effects, in your search for more efficient and profitable option trading strategies. We're going to start by talking about Greeks. And Greeks are risk sensitivities or risk measures. What this means is the Greeks help us understand what the risks are to a certain option position. For example, if we talk about delta, which is the one that we already looked at, delta measures how the underlying price affects the option price, how much the option price changes as the underlying price changes. In this case, we're going to start talking about theta, which is a measure of how much the option price changes as time to expiration changes or as time passes. In this case, theta measures the sensitivity of the option price to the passage of time. Or in other words, how much will the option price change in 1 day, assuming that nothing else changes? Like the underlying price, strike price, implied volatility, dividends, interest rates. So we freeze everything and we only change the time to expiration by 1 day. So 1 day less, 1 day passing. And we're going to see the difference between the option price before and the option price after. That's exactly what theta measures. And theta is going to be a number that's going to give you a good understanding of the price or of the amount that you're going to lose by holding a certain option. Theta is negative for long options and is positive for short options. It doesn't matter whether you're talking about calls or puts. When you're long an option, theta is negative for calls and puts, and when you're short an option, theta is positive for calls and puts. The option price is made up of intrinsic and extrinsic value, and at expiration, the extrinsic value for every option goes to zero. Theta is a measure of time decay. So this extrinsic value is going to go away, and at expiration, you're going to be left only with intrinsic value. If nothing changes, as time passes, this extrinsic value is going to start going away. That is what theta is measuring, if we assume that nothing else is changing, because implied volatility could change as well. But in this case, for this theoretical experiment, we're thinking about maintaining every other condition the same. If you look at a long call and at a short call, we've already looked at these. And as you can see, we always talk about a P&L line at expiration, which is this solid line. And then we talk about a P&L line at a time prior to expiration, which is this dashed line. If you look at this dashed line, and you start moving time forward, what's going to happen is this dashed line is going to start going, or is going to start moving towards the solid line, towards the P&L at expiration, and the factor or the Greek that is measuring what's going on when this dashed line becomes this solid line is theta. If nothing changes and you start, let's say here, okay, and you put a position in here, then as time passes, it's going to start going down and down and down until at expiration is going to hit the P&L at expiration. This is a visual representation of theta. Okay, at expiration, you're going to have something like this, a very sharp line here. And the dashed line is representing the option having at least some extrinsic value, representing the possibility that is going to go up or down. And that's what theta measures, how this value starts going away. When you're short a call, it's something different. In this case, you have a solid line measuring the P&L at expiration here, and then the dashed line measures the P&L at any time prior to expiration. When you start like at a point like here, and then the dashed line is going to start moving up. And as it moves up, what's going to happen is at expiration is going to reach and is going to merge with the solid line, with the P&L at expiration. The Greek that's measuring how this dashed line changes over time, if everything else stays the same, is theta. In this case, the dashed line is moving up, so it's giving you profit, so it's positive for you. And in the case of a long call, it's moving down, so it's actually affecting the position and losing you money. Now, in exchange for the money that you're losing by holding an option, you have the possibility or the probability of making a lot of money, because this could go higher by a lot. And the price you're paying for that, a sort of rent, if you want to see it that way, is theta. You have to pay for that to hold it in the hope that it's going to give you the profits that you want. With a short call, in this case, but it's the same with a put, but in this case we're analyzing calls. With a short option in general, what you're doing is you want things not to happen. You want the option not to go higher, for example, in this case, in the case of a call. So when you have less time, the probability that it's going to move against you is less. And because of this, it's going to start giving you more profits and more profits every time until at expiration, it gives you the max profit, which is the initial credit that you got when you sold the call if it expires out of the money. This is another graphical representation of intrinsic value and extrinsic value. So if you look at this graph and you look at this curve representing a long call prior to expiration, which is something like this, the actual value of that call is made up of two components, intrinsic and extrinsic. And intrinsic is very clear. In the case of a call, anything that's below the strike price is not going to have any intrinsic value, and as it starts going in the money or above the strike price, it's going to start gaining value at a rate of 1 to 1. So it's a very simple line. It's a very sharp angle here, and the extrinsic value is this line, which is a kind of a normal distribution like curve, and this is going to be the additional value that you are or that you have in your call that's additional to the intrinsic value. So for example, anything before or below the strike price is only extrinsic value, and as you start going in the money and getting some intrinsic value, this is the extrinsic value, the extra that you get because you have some time until it expires, and this represents the probability or the possibility that you're going to make more profits. Okay, so as you can see, the extrinsic value or time value peaks right at the money. This is where it has its maximum value, and it starts going down as you start getting further and further away from the money, from the at the money. And it doesn't matter whether it is in the money or out of the money. In terms of extrinsic value, the curve is very symmetrical. In this case, theta measures how this dashed or dotted line is going to start going down and moving until it reaches the solid blue line, which is what you have at expiration, only intrinsic value. Now we're going to talk about theta in more detail. Assuming that you have no dividends and that the risk-free interest rate is 0, just to make the calculations a little bit easier to understand. And keep in mind, this is not strictly mathematically accurate, but it's just a way to give us an understanding of what theta is and what it depends on. Theta can be measured by or can be calculated by having the standard normal distribution of D1 multiplied by the stock price, by the implied volatility, and divided by 2 times the square root of time, and then 365, so that we have a number that represents the theta per day. So the units of this value are going to be dollars per day. Okay, so we have what this all means. Theta is time decay in dollars per day. The standard normal distribution of D1 is this: stock price, implied volatility, time to expiration in years. Okay. Now, what is D1? D1 is a factor that is used when you look at the option pricing, at an option pricing model. It is not very important that you understand how this is calculated, but just know that this depends on the stock price, on the strike price, also risk-free interest rate, implied volatility, and time. The standard normal distribution is a normal distribution that has a mean of 0 and a standard deviation of 1. And this is how you calculate the value of n of D1 based on this curve and which value it has at a certain point in the curve. Okay? The important thing to understand here, and this is a formula that you don't need to learn. It's not important that you have this committed to memory or anything like that. But now that we're looking at this, it's important to understand what drives theta. And we know that it depends, that the main shape of theta is going to be something like the n of D1, because this is the curve, this is one of the factors here, and that's how theta is going to behave. We also know that it's going to be directly proportional to the stock price, so it's going to be higher as the stock price is higher. Okay, because if the stock price is higher, then you're going to have a higher option price altogether. Therefore, the theta, the amount that you need to bring it down by in one day, is going to be higher as well. So that's why it's directly proportional. Sigma, implied volatility, is also directly proportional, because the higher the value of implied volatility you have, the higher the option premium is going to be. And if the option premium is high, then the theta has to be higher as well. It's inversely proportional to the square root of time, and that makes the curve or the graph for theta have a very special shape, and we're going to analyze it here. So in this graph, you have theta versus the strike price. Okay, this is the at the money. And we are analyzing, this is theta per strike as time to expiration changes. So the green line represents the theta when there's a long time to expiration. The black line represents as time starts passing, you have less time to expiration. And the red one represents the least time to expiration. So basically something that's very close to expiration. So as you can see, you have a curve that resembles the normal distribution curve, but then as time starts passing, this curve that starts out as kind of short and fat starts getting a little bit thinner and taller until very close to expiration you have a curve that's very skinny and very tall. What that means is when time to expiration is very little, when you're very close to expiration, it's only the strikes that are very close to the at the money that are going to have a lot of theta. Okay, so you can see that at the money there is an acceleration in theta. So when there's a long time to expiration, you have very little theta, and then as time starts passing, it becomes more and more until when you're very close to expiration, you have a very high value of theta. And but when you have very little time to expiration, it's only the ones that are around the at the money that are going to be affected. So if you start analyzing something that's, for example, out of the money or in the money, or vice versa, because if you talk about a call or a put, but out of the money or in the money, you're going to see that they don't necessarily have the same type of acceleration. In fact, if you look at the curve, they might stay the same for a while and then they're going to start going down. So sometimes a lot of traders think and have this thought in their heads that theta starts out very small and then with time it starts accelerating, which is the case, but only at the money. And that's very important to understand, because if you have, for example, a call and you buy it here, at the beginning it's not going to decrease by a lot. So the theta is not going to affect you a lot. But then as time to expiration approaches, you're still going to have some value in extrinsic, but the theta is going to start taking more and more from it, and you're going to start losing the value at an accelerated rate. So it's important to understand this, because it's only the strike prices that are around the at the money that are going to be affected right at the end, so very close to expiration. The ones that are out of the money and in the money, the theta, as you can see, is more constant. It doesn't change as much. So yes, theta accelerates with time, but for the most part, that happens only to at the money options. Now, when you start out with a position, maybe some of the options that started out as out of the money now become at the money, so you have to watch out for that. These at the money designation, or this at the money strikes, are going to change based on underlying price. Where the underlying price is, that's where the at the money is. Okay, so it's not something that you start out as out of the money and then it's going to stay the same. No, it might become the at the money, it might become the in the money then after a certain time and after the underlying price changes. So it's important to understand how theta changes as time to expiration changes, and also how this is going to affect your positions. Remember, when you buy and you're holding an option, just by holding to it, you are having to pay a certain rent or a certain amount that you're always going to be losing, and that's theta. Now, how are you going to overcome that cost of theta? Well, if the option moves more than what you expected it to move in your favor, and then those profits offset theta and then give you some additional profit, then, well, you're going to be more than paying for the theta. It's only when you buy an option you want things to move in your favor, of course, and nothing happening is actually your enemy, because then it's going to start bleeding and it's going to start affecting the value of your options. We're going to look into this in a little bit more detail. I'm going to go to the platform, and you're going to be able to see this numerically and to see how this affects the different types of positions that we put on. So we're going to come to our trading platform, and we're going to take a look at Goldman Sachs. GS is the ticker symbol. And we're going to open up the some expirations here. I've already pulled up the theta so that you can take a look. So for example, we have here the a few of the strikes for the 6 days to expiration and for the 34 days to expiration. And what you can see here, this is theta, okay, this is delta. So if you look at the money, which is the 200 more or less, so we have when there's 34 days to expiration, the theta is at the money is 17, and the theta, let's say for the 230, or let's say the 210, which has a delta of 42, is 17 as well. 17, 17, 18. And it's a similar number for the puts as well. So one of the things that you can notice is when you decrease the number of days as time passes, you're going to see the theta number go exponentially higher, especially at the money, which is right here. It's now 42 cents instead of 17 cents. So 39 to 42, something like that. So you can see that with 34 days to go, this number is somewhat small. It's still 17 cents. This means that you're going to, if you buy this call in this case, you're going to lose 17 cents for every day that passes. But when you go very close to expiration, this number is going to be much higher. So it accelerates as you get closer to expiration. Now what we're going to do is we're going to focus on calls. And what I'm going to do is I'm going to buy the 205 call, a single contract, and we'll see how this changes over time. Okay, so I'm going to take this one. I'm going to buy the 205 call for Goldman Sachs. Okay, and I'm going to analyze it. Okay, now we're going to start analyzing. So we bought a call, the 205 call. Now we're long this call, and I want you to take a look at these numbers. These are the price slices, and I'm going to switch this number to standard deviation. Okay, so I'm going to go one standard deviation higher and one standard deviation lower. Okay, so at 201, so if nothing changes and the price stays right here at 201, because I bought the 205, I'm going to start moving time forward. Okay, take a look at the line at the curve, the purple line. Okay, as I start moving time, okay, and I'm going to change this so it's not confusing here, because this expires on July 17th. Okay, so again, let's start over. Okay, as we start moving time, you can see that that line is slowly merging, but see how the value, the profit and loss starts going lower, because that's theta affecting me, assuming that the price doesn't actually change. Okay, you can see until you hit expiration and it merges with it. Okay, so this is an example of buying a call. And now if you look at theta itself, just focus here at this number, look at this number and see how it starts going higher as time passes. Okay, 20, 21, 22, 23, 24, 25, 26. Now it's accelerating. 29, 30, 32, 34, 36, 39, 42, 46, 52. So you can see how the acceleration takes place when you're very close to expiration. And actually, this platform allows you to plot the actual value of theta. Okay, so theta is negative, of course, and you can look at it and you can see how the basic shape of theta right at the money. Okay, we have the 205 is the at the money, but the price right now is at 201. And if I start moving time, you can see how this number, now the actual axis changed, so it's still going even lower and lower and lower. Okay, so this is what's happening as time passes. Okay, this is the acceleration of theta, how theta changes. Okay. until on the 17th, we are on the 15th. On the 17th, this is where it peaks, okay? Right at the money. And then it ceases to exist, okay? So this is more or less how theta works. And now what I'm going to do is I'm going to do the same thing, but I'm going to do it for a short call. So I'm going to sell a call. I'm going to sell actually that same call. I'm going to sell it. So I'm just going to go from buy to sell. Okay. And I'm going to analyze it. And now I'm going to analyze this. So now this is where we are. And this is the value. Now you're going to see how the purple line, this is where the price is going to start going higher. Okay. As time passes. See? The line starts going higher and higher until it reaches expiration, at which time is going to have max profit because it's out of the money. 205 is at the money. Okay. Now, same thing, if we start analyzing the actual theta, which you can do here, you can see it's a similar shape of the curve, but it starts going higher and higher because now it's in our favor. See 20, see the axis here, 20. Starts going higher and higher and higher. And notice how the numbers that are increasing a lot are the ones that are at the money or near the money. These numbers over here, if you look at the shape of the curve, they're not going high, or they're not going higher by a lot. In fact, they're going down. Look at this one, the 180, for example. Look at those. Okay. You can see that it's only the money. So at the very, when you're very close to expiration, theta is mostly affecting the ones that are around the money. Okay. Since we're simulating the passage of time here, you can see that the theta itself is changing and it's concentrating around the monies. But we're going to switch back to P&L so that you can see how theta, summarizing what we learned today, theta is going to be positive for traders who sell options, and is going to be negative for traders who buy options. Now, the flip side to that is that when you buy options, so let's say we analyze this. When we buy options, there is a possibility of making unlimited profits. If it starts, let's say, for example, we buy a call, the value can go very high and I can make a lot of money. Okay. But for that benefit, for that advantage, I'm paying for it, and I'm paying for it in the form of a rent, and that rent is theta. Okay. So the flip side to paying theta, which is when you buy a call, is that you can make a lot of money. But of course, you can make a lot of money if what you want to happen happens. So if the price of the underlying starts going higher and higher, then you're going to start getting the profits that you're looking for. When you're selling, you are receiving the theta, but in exchange for that, you're exposed to the risk of that particular underlying going higher and then having losses that are much bigger than the profits that you could have made. You can only make the credit that you received, but you can lose much, much more. So this is the flip side to that. So you have to understand that for you to enjoy the advantages of unlimited profitability and also profits that start to grow exponentially, because as you start moving, say for example here, if you look at the call here, okay, as you start moving in the money and deeper in the money, you're going to start getting more deltas. Okay, so as you start moving, not only are you making money, but you're making more money as you go. That acceleration of profit is called gamma. And when you have gamma, you have to pay for it with negative theta. That's the exchange. That's the flip side to being positive gamma. And when you're selling, is the other way around. As the position starts moving against you, you start becoming more and more negative delta. So the deltas are moving in against you, okay? That's because you have negative gamma. And in order to enjoy positive theta, you have to be exposed to negative gamma. One cannot be had without the other. If you are positive gamma, you have to be negative theta. And if you're negative gamma, you're going to enjoy positive theta. That's the difference between buying and selling options. And when you start putting them together, for example, in spreads, or if you start selling iron condors or butterflies, or strangles or straddles, or you buy a strangle, buy a straddle, the thetas of the individual components are going to have to be added up to get the thetas for the whole position. That's another thing. And the whole position is going to have a certain theta and a certain gamma. And then they're always going to be mirrored images of each other. If you have positive theta, you're going to have negative gamma. And if you have positive gamma, you're going to have negative theta. One pays for the other. And both have their advantages and disadvantages. And it's up to you as an options trader to select the strategy that you feel the most comfortable with. So I hope that this was useful, and now you have the knowledge that you need to apply two of the most important Greeks, or the two most important Greeks, delta and theta. Later on, we're going to talk about gamma, and then we're going to talk about vega. There's plenty of Greeks, but we're not going to take a look at all of them. We're going to focus on those four, because you can perfectly be a very successful option trader if you know those four inside out. The other ones, the second order Greeks and the third order Greeks are important to understand, but they're not critical. These ones are critical. It's important for you to understand what theta is, and how it's going to affect you if you buy options, and how you can take advantage of it if you sell options. Thank you very much for your attention, and goodbye.